I'm Doug MacKenze.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back, everybody.
Hello.
How you doing, John?
I'm great. How are you?
I am doing pretty well.
Okay, good.
Yeah.
Looking forward to this show.
Yeah, same. And one thing that we wanted to just throw out there in the beginning, I think we've said this before, we're not the most technically savvy, but we're starting to figure out some things and we can see some stats. We see that we've actually got a pretty exponentially increasing base of listeners, which is very exciting to both of us.
Yeah, thank you, everyone.
Thank you to everybody that's listening every week, because it does appear that we have a nice section of people that are tuning in every time we release an episode. It would be hugely helpful for us if you folks could leave us a written review on whatever platform that you listen on. If you think that you're deriving value from our podcast, we would greatly, greatly appreciate it.
Yep. And thank you to the ones that have already.
Yep.
So thank you.
Yeah. So today we're going to talk about whole life insurance as a substitute to bonds in someone's financial plan. So just irrespective of infinite banking or anything like that, we're just going to talk about whole life insurance as a product and its merits as, replacing the bond aspect in someone's portfolio.
Yep. Yep, because they're trying to, the financial services industry is trying to get people to look at, certain allocations during certain times in their life, right? Certain age brackets, right? And as you get older, they think you should have more bonds than you have securities or stocks, right?
I mean, it makes sense.
Yeah. I mean, you're going to get more of the growth typically from the stocks if things go like they have historically, but that you want to have more or less risk, and that's the idea of allocating more and more over time towards the bond side, right?
Yeah, because when you're drawing income in retirement, you don't want to have as much volatility in your base of capital.
Right.
Yeah.
And risk of loss, obviously.
Yeah. Yeah. Exactly. And it has the bond allocation has not done well for people in the last really decade plus.
Yeah, right.
And especially in the last few years, it's been all over the place.
Right.
But we want to just talk about the merits of whole life insurance versus the merits of bonds, and why we think that bonds would be a very good whole life would be a very good replacement for bonds if you're looking at a balanced retirement plan or financial portfolio. I don't know if we have any financial planners listening. It might be good to listen to this with an open mind. I know that a lot of financial planners might not be open to suggesting this, especially if their business is done as assets under management and taking a fee of this, taking a percentage. Yeah. And for those that maybe charge a flat fee, this could be an interesting integration into their practice.
Right. Because the fee-based folks are more, to me, it seems to be more focused on fiduciary responsibility, right? Which is, hey, we're going to we're a consultant, we're an advisor, we're not looking, the more assets we have under management, we're getting a percentage of that. Well, then we don't want any of that flowing away to something like whole life insurance.
Even if it is better on paper.
Exactly.
Spoiler, that's what I think. So,
yeah.
Yeah. So, do you want me to go through some of this, John?
Yeah.
Okay. So, bonds that's what I always knew was the thing that people bought when they, were later in life, or even had a smaller percentage that generally grew larger as they aged. That was like the typical financial plan. And, buy bonds or CDs when you get older, things like that, fixed assets. So first, I don't think that most people understand what bonds are very well. And most people that think they're buying bonds are not buying bonds.
Okay.
So most people, when they're buying bonds, they're buying like a bond index fund of some sort. And they're, like the Vanguard bond fund or the
Right.
ETFs mutual funds, right?
Right.
So that is a holding of bonds that functions very differently than buying an actual bond.
Okay.
Buying an actual bond requires a lot more work.
Yeah.
You generally need to have a broker of some sort to help you out with that. And the bond market is massive. It's like many, 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 many times larger than the stock market.
Yeah.
I was surprised when I learned that.
Yeah.
Yeah. And there's a lot out there. So when you buy a bond, you are buying something that is going to pay you a fixed payment rate and then is going to typically return that capital to you at maturity of the bond.
Correct.
It's not reinvested into the bond.
Yep.
So somebody strictly buying bonds for themselves, if they're trying to do that for income and they want that to be reinvested as they would in another type of fund, would need to manually do that by buying more bonds or by buying another type of asset.
Right.
So again, work.
Yeah. You've got to manage it. Yeah.
Yeah. And so most people, though, buy a bond fund, mixed bond fund, short-term, long-term, different types of bond funds. And what happens in a bond fund, and why a lot of people have kind of had a hard time lately, is when yields go up, which is nice, right? It's always good when yields go up.
Yep.
Your capital base goes down. The value cumulatively of those bonds being sold goes down.
Right. They're inverted. Yep.
Exactly. They're inverted. And people that were buying bonds just for capital appreciation did actually very well when, interest rates were plummeting for a long time, because the opposite will happen.
Right.
But if you're somebody looking for, income and not losing your capital base, it's not a good situation when yields go up like that.
Yep.
There's also risk of loss with bonds, depending on the bonds that you're looking at.
Yep.
So bonds can default.
Yep.
Right. And I don't, when you look at like an insurance company, they're buying actual bonds and holding them to maturity and taking those. They have teams of people that manage that.
Yep.
That are much better than you and I at understanding this.
Yeah.
Yeah. So bonds are less risky than stocks. We can agree on that. Okay. But when we look at whole life insurance, we have something that is a similar risk profile. So we're not going to be comparing whole life insurance to stocks, because that doesn't make any sense.
Yeah.
We have something of a similar risk profile and something that's going to generate a somewhat similar rate of return over time.
Yeah.
Okay. Whole life insurance as a product has less risk. Okay, you're not subject to that interest rate risk. Your basic capital is going to stay the same always.
Right. Great point.
It's never going to go down.
Yeah, that's huge.
Yep.
Yep.
You're going to continue to get paid dividends, no matter what, unless something, super catastrophic happens, right?
Right.
And we've talked about this on previous episodes. Yeah. They've paid dividends for...
Yeah. Well over 100 years.
Yeah.
Yeah.
Consecutively. And these insurance companies have credit and security ratings that are up there with the federal government. Actually higher. We talked about this.
Yeah.
Higher than the Treasury.
Yeah.
So there's no risk of loss.
Yep.
You have that steadily increasing rate of return.
Yep.
And you have a death benefit.
Yeah, let's not forget the death benefit. Yep.
Do you know of any bonds that pay a death benefit?
No. Well, no, I've never heard of one.
So, John and I have kind of thrown around this idea, and I've heard it talked about as well, but looking at incorporating this, again, not even as part of an infinite banking setup, but looking at incorporating this into someone's financial plan solely for retirement income or something like this is hugely powerful.
Yeah.
Because you're setting someone up with this, safe base that they would normally do with bonds that doesn't have this risk of potentially going down or fluctuating more that you want, and is going to provide this kind of yield that a retiree might want for retirement income.
Yep.
All while letting them use the income in the meantime,
Yes.
leading up to that while they're saving for retirement.
Exactly. Why would you do it any other way? I mean, when you compare the two options, right?
Yeah.
When you have access to leverage that value throughout the period of time that it's growing, there's no bond fund like that.
Yeah, and assuming that someone can be underwritten for whole life insurance, and can, has the time to do it, it's honestly superior in every way that you look at it.
Yeah.
So it's going to provide the yield, it's going to provide the income. You have current use of the cash value while you're saving if you need to, so it acts as like an emergency fund, and then of course tax benefits.
Yeah.
So, bonds, obviously, unless you're holding them in a non-taxable account, they are taxable.
Right.
Every time you take a distribution from that bond fund, which is not in your control.
Right.
Bonds distribute what they distribute.
Yeah.
Right. And so whole life policy distributions, if done correctly, either by withdrawals up to cost basis or policy loans, you're not going to pay tax.
Right. Right. Well, we're talking about this mostly because of the fact that in these whole life insurance companies invest in treasuries, which is the U.S. bond market, right?
Yeah.
And people think, oh, why would I give my money to the insurance company so they can do it?
Yeah, I'll just go buy bonds.
Yeah, I'll just go buy bonds. But you don't get all these other benefits.
No. And buying bonds, honestly, buying bonds as they're meant to be bought is a very complicated process, and it requires a lot of work.
Yeah.
And you're also, most people aren't qualified to do that or understand what they're doing. So to compare yourself to a very well qualified group of some of the most sophisticated financial people on the planet is a bit silly.
Right. But you're not doing it blindly like you do when you invest in stocks. Well, let's just go back to sort of qualified plans like 401ks, 403bs, IRAs, all that stuff. And you buy mutual funds, and that's how you get into the stock market. And then you might get an income fund, they call them, right, which is the bond side of it, right? You're not going into a whole life policy or what we're trying to help people gather for knowledge, right? You're not going into it blindly. You know what this is about and what the value of it is to you in your life. And when you just have a percentage of your income thrown into the market, whether it be bonds or be stocks, most people don't know what they own.
Well, yeah, and I mean, an index fund of bonds is still the market.
Right.
It's and I know that when I get to the point where I'm wanting to live off of passive income or be reliant upon that, I'd be pretty unhappy to see what I thought was going to be like this safe asset class dropping by 10, 15, 20%, which it did. Some of these funds have not done well the last few years. Now, granted, a lot of them have come back, but you still need to withdraw from that when it's down if you're relying on that for income.
Right.
That's the danger of some of these saving plans is that, if the things are down and all you have your money in is things that can go up or down and it's all down, you are going to be taking out at a very inopportune time. And I would know that for me, I'd want a very good base of capital, at least a percentage of that in something that I know is never going to go down.
Right.
We've talked about this. I don't check balances on my whole life policies. Do you?
Nope. Well, once in a while I do.
Yeah, but I'm not like in there tinkering, seeing what it's doing day to day.
No.
Why? You wouldn't need to do that.
Yeah. It is similar to what a prospect said to me, I want to set it and forget it kind of idea.
It is.
Right?
Yep.
it's going to do what it's going to do, but it's going to be available for you to do some of the things you want to do with your cash flow in your stockpile, in your warehouse of cash, right?
Yeah. Yeah, and I mean, when you're looking too at, passing these things on to your family, if you happen to outlive your retirement income, if you have a bunch of money that's tied up in stocks and bonds, that very well may incur a pretty hefty taxable event when it's passed on, or there's going to be rules that people have to follow and the amount of time that they need to withdraw it from certain qualified accounts. Yeah. With this, it's neat, it's easy. It's a tax-free check that goes to the people that you want to go to.
Yeah, so I always go back to the whole reason we're doing this work and why we're creating these podcasts, right? Which is, hey, I don't want my money tied up. Why would it? Because when it's tied up in a way that question whether I should sell it, take the tax hit, do all this kind of stuff, I still may have the need for financing. So I go out to another financier as opposed to myself.
Mm-hmm.
So, I mean, literally, you're growing your money in these whole life policies and you're able to access them, to leverage them. Why would you? I mean, you're gonna make decisions off of that stuff being tied up, and you're gonna go elsewhere. And then this whole thing we talk about, which is all the controls lost, the flow is going in the wrong direction. And so we're covering all of what the stock market talks about, the bond market talks about, the financial services industry talks about. It's all in this one financial product. It's all in this whole life policy. And if structured properly for your needs, it's going to serve everything you need for your lifetime, and it's even going to keep going and going and going. And it's just reversing the flow of everything. I just can't say it enough.
Yeah, right on. Yeah, I mean, if anyone out there is listening that's contemplating their financial plans for retirement, for just their general financial strategy, and you're curious to see what passive income can look like from one of these policies and how this could maybe complement your financial strategy or replace your bond holding, we'd be happy to show you that. And I think you'd be pretty surprised at what we can show you.
Yeah.
I know I was at first.
Yeah.
So
I agree.
Yeah.
Yep.
Well, listen, good stuff, John. If anybody has any questions, as always, shoot them our way. And please, if you could get to it, leave us a written review. We'd greatly appreciate it.
That would be a great help.
Yep.
Want to get this out to more people. If you find it valuable, you can be sure others will too. So
well
thank
said.
you. Yep.
All right, John. Have a good one.
All right. You too, Doug. Thanks.
Bye.
Bye. Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.